The financial crisis of 2008 stands as one of the most consequential events in modern economic history, not merely for the scale of its economic impact, but for the profound erosion of trust it caused within financial institutions, markets, and governments worldwide. Long before the collapse became visible to the general public, a complex web of structural vulnerabilities had been quietly forming within the global financial system. These vulnerabilities were not the result of a single decision or isolated failure, but rather the cumulative outcome of incentives, assumptions, and institutional behaviors that gradually detached financial activity from underlying economic reality. In the years leading up to the crisis, global financial markets experienced an extended period of optimism characterized by abundant liquidity, low interest rates, and widespread confidence in the ability of markets to manage risk efficiently. Financial innovation accelerated rapidly, producing increasingly complex instruments designed to distribute and repackage risk. While these innovations were often presented as tools for stability and efficiency, they simultaneously obscured transparency and weakened accountability. Risk did not disappear. It was merely relocated, transformed, and misunderstood. Central to the unfolding crisis was the expansion of credit, particularly within the housing sector of the United States. Mortgages were extended to a broader segment of the population, including borrowers with limited credit histories or unstable income. These loans were not inherently problematic in isolation, but their integration into a highly leveraged financial ecosystem magnified their systemic importance. Mortgages were bundled into securities, sold to investors, and further divided into complex layers that promised varying levels of return and perceived safety. As demand for these financial products grew, standards gradually deteriorated. Incentives within financial institutions favored volume over resilience, and short-term profitability often outweighed long-term stability. Risk assessment models, heavily reliant on historical data from periods of relative stability, failed to account for the possibility of widespread and correlated market stress. The assumption that housing prices would continue to rise became deeply embedded in both institutional strategy and market psychology. Rating agencies played a pivotal role in reinforcing confidence across the system. Their assessments assigned high ratings to securities that were, in reality, deeply exposed to systemic risk. These ratings were widely relied upon by institutional investors, regulators, and policymakers, creating an illusion of safety that extended far beyond the underlying assets. The separation between those who originated financial products and those who ultimately bore the risk further weakened incentives for caution and due diligence. As leverage increased, financial institutions became increasingly interconnected. Balance sheets expanded dramatically, often supported by short-term funding mechanisms that depended on continuous market confidence. In this environment, liquidity was abundant as long as trust remained intact. However, the same structures that facilitated rapid growth also amplified vulnerability. When confidence began to erode, the system's dependence on constant liquidity quickly became a critical weakness. The initial signs of distress emerged as housing prices began to stagnate and, in some regions, declined defaults increased, particularly among borrowers with adjustable-rate mortgages who faced rising payment obligations. What initially appeared to be a contained issue within a specific market segment gradually revealed deeper structural fragilities. As losses mounted, uncertainty spread through financial institutions that held or were exposed to mortgage-related assets. The complexity of financial instruments made it difficult to determine where losses were concentrated. Institutions became uncertain, not only about the health of their counterparts, but also about their own exposure. Interbank lending slowed as trust diminished, and markets that relied on confidence and transparency began to freeze. Liquidity, once plentiful, became scarce almost overnight. The collapse of major financial institutions marked a critical turning point in the crisis. These failures were not merely corporate events. They represented a systemic breakdown that challenged fundamental assumptions about market stability. Governments and central banks were forced to intervene on an unprecedented scale, deploying emergency measures to stabilize markets and prevent a complete financial collapse. These interventions underscored the extent to which private risk had become public responsibility. Public confidence was deeply shaken as the crisis unfolded. The perception that financial institutions had operated beyond effective oversight, while benefiting from implicit guarantees, fueled widespread skepticism toward both markets and regulators. The crisis exposed a disconnect between financial activity and broader economic welfare, raising questions about the purpose and governance of modern financial systems. The global nature of the crisis highlighted the interconnectedness of modern economies. Financial distress in one region quickly transmitted across borders, affecting markets, institutions, and households worldwide. International trade contracted, unemployment rose, and economic growth slowed sharply. The consequences extended far beyond balance sheets, influencing social stability and political discourse in many countries. In the aftermath of the crisis, attention shifted toward regulatory reform and institutional accountability. Policymakers sought to address the structural weaknesses that had contributed to systemic vulnerability. Capital requirements were reassessed, risk management practices were scrutinized, and efforts were made to enhance transparency within financial markets. While these reforms aimed to restore confidence, they also acknowledged the limits of regulation in the face of innovation and global integration. The crisis also prompted a re-evaluation of economic models and assumptions. The belief that markets are inherently self-correcting was challenged by the scale and persistence of the disruption. Greater emphasis was placed on systemic risk, behavioral factors, and the role of incentives in shaping financial outcomes. These insights contributed to a more nuanced understanding of market dynamics, though consensus on their implications remains elusive. Trust, once lost, proved difficult to rebuild. Financial institutions faced lasting reputational damage, and public skepticism toward complex financial products persisted. Investors became more cautious, and regulatory scrutiny intensified. The relationship between finance and society entered a period of reassessment, marked by debates over fairness, responsibility, and long-term stability. The legacy of the 2008 financial crisis continues to influence financial systems today. Its lessons remain relevant as markets evolve and new forms of risk emerge. While conditions have changed, the fundamental challenges of transparency, incentive alignment, and systemic resilience endure. The crisis serves as a reminder that financial stability depends not only on innovation and growth, but also on trust, discipline, and institutional integrity. In documenting the events of 2008, it becomes clear that the collapse was not the result of a single failure, but the culmination of interconnected decisions and assumptions that gradually undermined the foundations of the financial system. Understanding this history is essential not to assign blame, but to recognize patterns that may reappear under different forms. Financial history, when examined with clarity and neutrality, offers insight into the fragile balance between risk and confidence that defines modern markets. The financial crisis of 2008 remains a defining chapter in the record of global finance, illustrating how the erosion of trust can transform localized vulnerabilities into systemic collapse. Its impact reshaped regulatory frameworks, altered market behavior, and influenced public perception of financial institutions. More than a moment of economic disruption, it stands as a structural lesson in the consequences of complexity without accountability. As financial systems continue to evolve, the events of 2008 serve as a reference point for both caution and reflection. They demonstrate that stability is not guaranteed by scale, sophistication, or historical precedent. Instead, it depends on the continuous alignment of incentives, transparency, and trust across institutions and markets. The collapse of trust in 2008 revealed the true cost of neglecting these principles, a cost that extended far beyond the financial sector itself. This episode, preserved within the broader archive of financial history, illustrates how confidence functions as an invisible, yet essential component of economic systems. When trust is sustained, markets expand and capital flows freely. When it is compromised, even the most complex and powerful systems can unravel with remarkable speed. The financial crisis of 2008 stands as enduring evidence of this reality, reminding future generations that financial stability is ultimately a matter of collective belief as much as mathematical calculation.